Welcome to Breaking News to Trading Moves. Today we're focused on a corporate transaction involving one of the world's largest energy companies and its iconic consumer brand, Castrol. For you, our listener, we've been looking at the analyst reports and market reactions to really explore the mechanics of this deal. Our goal here is to quickly synthesize what's happening, highlight the financial trade-offs BP is making, and of course, identify the resulting perceived winners and potential losers across different market sectors. So let's start with the headline. BP has reached an agreement to sell a controlling stake, that's 65% of its Castrol lubricants business, and the buyer is the U.S. investment firm Stonepeak.
Yeah, and this is a major structural change for BP. The valuation of the deal itself is pretty substantial. The whole transaction values the Castrol business at about $10.1 billion.
$10.1 billion, and BP is selling, what, 65% of that?
Exactly. They're selling that majority stake for about $6 billion in cash.
$6 billion immediately changes things for BP, but what about the structure? I mean, are they walking away from Castrol entirely?
No, not at all. BP is going to retain a 35% ownership stake.
Okay.
This is all going to operate under a joint venture structure with Stonepeak. And one detail that jumped out is a 2-year lock-in period.
A lock-in.
Right. So after those 2 years, BP then has the option to sell that remaining stake.
Yeah.
It suggests, a careful staged exit, not a fire sale. And there are other immediate financial benefits here, too. BP expects to get about $800 million in accelerated dividend payments that are tied to this transaction.
And the timeline.
The expectation is that it will close by the end of 2026.
All right, let's focus on BP's motivations. Why would they shed such a well-known, high-margin brand like Castrol? The consensus view is that this is really less about the lubricant market itself and more about meeting some very specific corporate finance goals. This $6 billion cash infusion is a key piece in BP's strategy to hit its stated $20 billion asset sale target. And that cash is instrumental in their larger goal of reducing net debt. They're aiming for a range of about $14 to $18 billion by the end of 2027. So this sale gives them some immediate breathing room.
That's really the heart of it. When you look at the strategy, it's being framed as a classic financial decision, the cash now versus cash later trade. The bullish argument for BP is pretty clear. This move instantly gives them balance sheet flexibility. They get cash immediately, which accelerates debt reduction and, it creates options for future capital allocation.
Like shareholder returns.
Exactly. Potentially supporting higher distributions through things like share buybacks or maybe even increased dividends.
But every trade-off has a cost. So if the upside is all this future flexibility, what's the downside?
The counter-argument, and you see this from some analysts, is that BP is giving up an exceptional earnings stream.
Right. Castrol is a cash cow.
It's a high-quality, durable, cash-generating business. It's often described as a sort of low-volatility asset that historically gave them stability and predictability. It acted as an anchor for their dividend, no matter what crude oil prices were doing.
So they're trading that proven stability for immediate financial optionality.
It's a calculated risk. That's a good way to put it.
And that one decision, BP choosing cash, now sends out signals far beyond just the energy sector. Let's look at the companies perceived to be the beneficiaries, starting with the big integrated oil companies that are prioritizing asset monetization. The market response here is telling. It really reinforces a playbook that investors seem to appreciate right now.
Which is?
Simplify the portfolio, raise cash from non-core assets, reduce leverage, and then put that cash towards supporting distributions. This sale also sets a new valuation marker. It tells the market what these specialty downstream assets are worth.
And that could pave the way for similar sales by their peers. When analysts talk about who benefits from this sentiment, they obviously cite BP itself, ticker BP.
Okay.
But also ExxonMobil, ticker XOM, and Chevron CVX. These are all companies with complex portfolios, and seeing BP get a clean, high-valuation sale like this validates their own potential monetization plans. Now, the next group of beneficiaries is listed alternative asset managers. The buyer, Stonepeak, is a great example of an institutional investor with very deep capital.
So what does Stonepeak's interest here tell us about that whole sector right now?
Their acquisition just highlights this continued, robust appetite for assets that generate long-duration, predictable, and inflation-resilient cash flows.
So they're treating it almost like an infrastructure asset.
That's it, exactly. Even though Castrol is a consumer brand, they're buying the predictability of the cash flows. It's almost like a toll road or a regulated utility. It's the stability that attracts them. And the signal this sends is overwhelmingly positive for the large listed platforms that raise capital, deploy it into these real assets, and then earn steady management fees.
So we're talking about the big players here.
Yes. Names that benefit from this sentiment include Blackstone, ticker BX, KKR & Co., there's KKR, and Ayers Management, ticker ARES. They all manage massive amounts of capital looking for this exact type of stable return.
Okay, a third category of beneficiaries. Auto aftermarket retailers. This is where the impact moves from Wall Street right down to the local service bay. When a financial sponsor like Stonepeak takes control of an established brand, they typically come in with a mandate to accelerate growth and maximize returns, right?
Right.
And that often means pushing aggressive new commercial initiatives.
Exactly. Analysts are anticipating new distribution partnerships, maybe increased marketing spend to drive sales, and expanded product lines or pricing programs.
So more ads, more deals.
You got it. And even if Castrol's own market share only shifts a little bit, that general influx of marketing and promotion tends to lift the overall volume through all the major retail and service channels. It sort of makes the whole pie a little bigger for everyone. The companies seen benefiting from this predicted increase in activity include O'Reilly Automotive, ticker ORLY, AutoZone, AZO Genuine Parts Company, GPCC, and LKQ Corporation, ticker LKQ.
Right, now let's turn to the other side of the coin, where analysts see immediate risks. First up, the standalone oil change and lubricant service operators. If the new owner's playbook is aggressive growth, I imagine the downside for established players is just intensified competition.
That's the risk, precisely. A sponsor-backed Castrol will probably be leaning into growth. You'll see sharper channel incentives for their partners, more advertising aimed at consumers, and maybe expanded service partnerships with national chains.
Which puts the pressure on everyone else.
It does. This increased competitive intensity puts pressure on the margins and market share of the independent operators, the ones who rely on stable pricing in that quick loop space. The names analysts point to as facing this pressure are Valvoline, ticker VVV, Driven Brands, DRVN, and Monroe, MNRO. They'll likely have to meet Castrol's new incentives or risk losing ground.
Okay, the second category of risk is found among the specialty chemical and additive suppliers. This goes right to that private equity cost-out strategy we mentioned earlier. When a financial sponsor takes over, one of the first things they do is look at improving profitability, and that usually starts with the supply chain. So what does a cost-out strategy actually look like for Castrol suppliers?
It means procurement pressure. It typically involves rebidding supply contracts on a regular basis, demanding tighter product specifications to squeeze out any waste, and just enforcing tougher pricing across the board.
And Castrol is a huge buyer.
A massive buyer of lubricant base oils and specialized additives. So even if their sales volumes stay completely stable, the margins for the companies supplying those raw materials could come under immediate and sustained pressure from Stonepeak's procurement team. The companies that could face this squeeze include Innospec, ticker IOSP, Eastman Chemical, EMN, and LyondellBasell Industries, ticker LYB. Their negotiations with a new, cost-focused Castrol are expected to be a lot less generous than they might have been with BP.
Finally, let's look at a third category, companies seen as energy transition names. The risk here is less about direct financial competition and more about sentiment, but the narrative. BP's decision to sell Castrol is explicitly linked to prioritizing cash flow for its core oil and gas business. So what does that signal about the pace of the broader energy transition, and how does it affect renewables?
Well, this action reinforces a narrative in the market that, at least for now, some major energy companies are choosing to prioritize immediate hydrocarbon returns over longer-term spending on the transition.
I mean, they are monetizing a future-proof, non-hydrocarbon asset to fund legacy operations.
That's it. And that narrative can create a negative sentiment for parts of the renewables complex, the companies that are seen as pure-play transition players who rely on that continued capital deployment from big oil. The names often cited here are companies whose valuations are very sensitive to that narrative, like Enphase Energy, ticker ENPH, SolarEdge Technologies, SEDG, and Plug Power, PLUG.
So to summarize what we've reviewed for you today, BP is executing a very clear financial strategy. It's monetizing a stable, income-generating asset Castrol to meet some immediate large-scale debt reduction targets. And this trade-off, current earnings for future flexibility, sets up some measurable market reactions for companies all across the energy complex, alternative asset managers, and auto retail. It creates specific winners and losers based on that capital flow and the new owner's mandate.
And as you look forward, here's something to consider. Given this need for efficiency and cost-out strategies under the new ownership, How much capital and organizational bandwidth will Stonepeak really allocate toward continued investment in next-generation sustainable lubricants?
Yeah.
And how might prioritizing margins over environmental tech affect Castrol's long-term brand positioning in the global market?
And finally, a reminder for everyone listening, this discussion is not financial advice or a recommendation to buy or sell any security. This analysis is purely the opinion of the author of the material reviewed.